Dear students, I have come with a new module, module 7, and in this module I am going to talk about distinction between capital loss and revenue loss. You know that capital and revenue we have divided into three. One is capital income versus revenue income. Second, capital expenditure versus revenue expenditure. And third is capital losses versus revenue losses. So this is the third topic we are going to learn in this module. Now, just like the similar other two modules, I am going to explain this topic in 3 points. First one is, what is the need for distinguishing between capital loss and revenue loss? Second, I will give you a table which will explain the distinction between capital loss and revenue loss. 4 points will be there. Third is, there are certain deciding factors how you can distinguish between capital loss and revenue loss. So this is the schedule of presentation, and then we are going to start with the first topic. First topic is need for differentiation between capital and revenue losses in income tax. Why we have to distinguish? If you are not distinguishing between capital loss and revenue loss, what will be the consequences? So first one is tax treatment. First point, income tax treatment itself. So capital losses can be set off only against capital gain. That is either long term or short term. It cannot be adjusted against business income, salary income or income from other sources. Whereas in the case of revenue loss or the business loss can be set off against any income except salary. So this is a major difference. We have to distinguish between capital loss and revenue loss. So that is the difference in the income tax treatment. First one, capital loss can be set off only against capital gains, whereas revenue loss can be set off against all other incomes except salary income. Second point is carry forward rules. Carry forward rules, carry forward meaning if you are not able to set off the loss in 1 year, then you can carry forward for few years, either 4 years or 8 years. You are going to learn this as a separate topic later, separate chapter. Carry forward and set off of losses we have to learn. So in the case of capital loss, it can be carried forward for 8 assessment years, but only to be set off against capital gains. Whereas in the case of revenue loss, it can be carried forward for 8 assessment years, but it can be set off against business income in future years. So the number of years you can carry forward is same. In both the cases it's 8. But in the case of capital loss, it can be set off only against capital gain. Whereas revenue loss can be set off against business income for 8 assessment years. So the heads of incomes are different. Third point is helps deductible, whether this can be allowed as a deduction. The third point is helps to determine allowability, whether this expense can be allowed as a deduction, whether it is coming under capital loss or revenue loss. So capital losses are not allowed as deduction under profit and gains of business or profession, whereas revenue losses are deductible while computing business income. You have to remember, if it's a capital loss, it can be adjusted only against the capital gain, whereas revenue loss we are adjusting under business or profession. Next is avoid tax manipulation. Income tax manipulation is a serious crime, that is tax avoidance, tax not paying tax at all, or giving wrong income tax information. All these are treated as serious offences by the income tax department, and you will have to face the consequences. So without clear distinction, taxpayers could misclassify capital losses as revenue losses to claim quicker or broader tax relief. The distinction ensures tax fairness and compliance with legal requirements. So it's very important that we have to distinguish between what is capital loss and what is revenue loss. Revenue loss, you have to remember, it's due to the day-to-day, the current financial year losses. Whereas capital loss, it's usually related to the capital asset. Now, impact on book profit. If you are not classifying the capital loss and revenue loss, it will definitely affect the profit. So revenue losses may affect the book profits because definitely either profit will be inflated or deflated. Wrong information, giving wrong profit will affect so many people, investors, shareholders, financial institutions, so many people, because everybody will take that as the authentic statement for taking business decisions. Capital losses do not impact book profit unless specifically adjusted. So these are the 5 points we list. What is the reason for distinguishing between capital loss and revenue loss? First is tax treatment itself is different. Second is carry forward of losses. It's allowable for 8 years, but in the case of capital loss, it is adjusted only against capital gain. Business loss, revenue loss can be adjusted against business loss. Third point is deductions, allowable deductions. The fourth is tax manipulation. If we are not distinguishing properly between capital loss and revenue loss, tax manipulation is possible. And fifth is it will affect the profit. Now we will come to the second topic I want to discuss. Second topic is I am giving a statement that is distinguishing between capital loss and revenue loss. That is with 4 points I have explained. Set off against. Set off. Set off, you know that carry forward. Set off is capital loss can be set off only against capital loss. Revenue losses can be set off against all other heads of income except salary income. Second is carry forward. Carry forward is same. In both the cases it's 8 years. Whether it's capital loss or revenue loss, it's 8 years. But the heads of income are different. That is the distinction. Capital loss will be adjusted only against capital gain. Whereas revenue loss, we will adjust with the all heads of income. Like except salary income. That means it's possible with business, it's possible with income from other heads, all this. Then deductibility. Deductibility. In the case of deductibility, you have to remember, capital loss we are allowing depreciation. It's not allowed as a business deduction. It's over a spread of or a number of years, it's allowed as a deduction. Whereas revenue loss allowed as a business expense. If stock in trade is lost, it will be immediately, that year itself it is adjusted. Tax planning impact. Tax planning. This is limited. In the case of capital loss, it's limited. Whereas revenue loss, more flexibility is there. If you plan your operations properly, then even if some loss, revenue loss, it can be adjusted in that year itself. So here 4 points we are distinguishing between capital loss and revenue loss. One is set off. Capital loss we are setting off only against capital gain. Whereas revenue loss, all heads of income except salary. Second is carry forward. You have to remember both the cases, it's 8 years it can be carried forward. But the distinction is set off is allowed in the case of capital gain for 8 against capital gain. Whereas revenue loss, it is adjusted against all heads of income except salary. Now deductibility, capital loss is not allowed as a regular deduction. Like depreciation we are charging for number of years. Capital asset, that is how the value is depreciated. Whereas any revenue loss, it's allowed as a business loss. That year itself it's adjusted. That is loss due to stock, loss in stock or cash embezzlement. All these points will come as revenue loss. Tax planning. In the case of capital gain, it's limited because when it's sale of a capital asset, when loss is there or anything, then only we can adjust.